Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review. Feb 22, of course, but this is for the week ending Feb 19. A bit like last week, there's so much to get through. We just could not fit it in by the close on Friday afternoon, so we are doing it Monday instead. We'll talk about all of the key broker moves for the week after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees for fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today is to delve through the hundreds of broker upgrades, downgrades, price target increases and decreases from last week. Of course, we are in the middle of half-yearly earnings season. Some companies half-yearly reports, of course. Some companies are doing quarterly reports, some full-year reports, AGMs. It is on at the moment. So plenty to do as an analyst and plenty to do for the brokers as well. Then we'll have a look at a few stocks of interest. Let's kick off proceedings today with the upgrades. Each broker, of course, has a rating system: buy, hold, sell. Some examples there. In between those three and outside, of course, outperforms, underweights, the vagaries of broker ratings. But nonetheless, broadly speaking, telling you what they think their clients should do with that particular stock. They'll also tend to have a valuation for the company and therefore a price target where they think the company can get to in terms of its price over the next 12 to 18 months or so. So we'll talk about the ratings changes here, and we can see, for example, Credit Suisse, big Swiss broker, has upgraded Crown Resorts from neutral to outperform, so heading in the right direction for Crown. They also changed their price target from $10.35 to $12. That's an increase of 15.9%, and based upon that current target price and the current share price, that leaves us with about 17% until we get to the target. So the broker is seeing quite a bit of upside left in the company. So that's the key to unlock the data on screen. For each of the slides we're going to go through today, there's plenty of detail, so I encourage you to press pause on this recording and have a close look and see if the stock you're interested in is on screen. We'll have a very broad overview because there are so many to get through this week. Apart from that, let's look at perhaps the moves to buys, for example. There tend to be the biggest vote of confidence. So JP Morgan on Whisper, that's the technology communications company, from hold to buy, increasing the price target by 3%, seeing about 8% left in that one. Next one down, car sales from UBS, also going to buy, a much bigger price target increase and a fair bit still seen in that one. We'll cherry pick a little bit here. Tabcorp neutral to buy, 20% increase in the price target with another 15% seen in that one from Citigroup. Looking down our list, a price target decrease here as we go from neutral to buy on Altium, but I think that's probably more important than the small decrease in price, and there's still 15% seen in the share price there. Heading down the list into Altium again, from UBS, also neutral to buy. Whilst we're seeing a small decrease in the price target, we're still seeing quite a bit left in terms of upside. Credit Suisse going to outperform at GPT, small decrease in the price target. Bit of a theme here, isn't it? But still plenty of upside seen on that one. Not so lucky heading into the downgrade. So these stocks saw their ratings downgraded, for example, from outperform to underperform, which is pretty rare because you go outperform, then you might have neutral, and then you might have underperform here, and you're going to have probably buy on top of that and sell beneath it. So to go two rating steps is actually pretty rare for brokers. So gives you an idea of what Macquarie thinks about Appen at the moment. They also slashed their price target by nearly 30%. And incidentally, the current share price is above that target by about 12%. So Macquarie Bank is seeing quite a bit of downside in Appen. So Appen shareholders, take note of that one. Coles Group, we'll talk about this one a little bit later on. A couple of downgrades here from Citigroup and Credit Suisse, from buy to neutral and outperform to neutral. We also saw those price targets coming down, but still a bit of upside seen in the targets from there. CSL, another one we'll discuss a little bit later on when we do our stocks of interest. Buys, outperforms down to neutral. We did see one price target decrease as well, but once again, a bit of upside still seen in that one. Heading down the list, I'll let you press pause perhaps and look at those in your own time, because we've got about 150, I think there was, price target increases to get through. We'll kick off with Ansell. So Ansell reported half-yearly profits this week, and just looking at my notes here, because I can't remember them all, they said that their first half net profit was up 62%, and that was on the back of a huge increase in demand, of course, for protective equipment due to the COVID pandemic. More importantly, they said that they expect a lot of these trends to continue as just in general, people's hygiene becomes better, and therefore, in various industries, the demand for PPE continues to remain strong. And that allowed for a 53% increase in their dividend as well. So brokers, as you can see, generally very happy with those. We've got price target increases from 6 of them. JP Morgan in particular, they saw a 10% increase in their price target, still about 13% on. Upside in that one is 18% there at Credit Suisse, 10% at Citigroup. So generally, apart from Macquarie, quite a bit left in this one. The JP Morgan analysts said that Ansell had taken advantage of the COVID disruption and was gaining market share from competitors as well, because they were just better prepared than their competitors. And the company's in a very strong position as the world starts to recover from the pandemic. Apart from that, we saw ANZ with their first quarter update. They flagged higher dividends as they reduced their provisions for bad loans. Their mortgage book grew as well. They said the economic outlook was improving. Statutory profit for the December quarter was $1.6 billion, up from a quarterly average of just $773 million in the first half of last year. CEO Shane Elliott said that during the December quarter, things weren't nearly as bad as initially thought, and the outlook had improved markedly. We saw 3 price target increases here of varying magnitudes, but a nice one there from UBS. I'd suggest just catching up, but they do have that buy at the moment outperformed from Credit Suisse. So pretty positive there for ANZ and the rest of the banks, as we'll see in a little while. Four-wheel drive parts accessories business ARB reported a 21.6% increase in their sales for the half year, but a massive 113% jump in net profits to $54 million. Well received here by the brokers with nice price target increases, but I would note that the share price has run pretty strong of late, and that puts some of those price targets above where the current share price is. We do have a buy there from Citigroup, but neutrals from Credit Suisse and Macquarie. Again, press pause if there's a stock you're interested in, of course, and you can check it out. I'm just picking out a few that I thought were pretty interesting. Bapcor, they are the auto parts wholesaler. They also own Autobarn, Burson, Auto Pro, and a few other brands. They lifted their dividends to 9 cents a share. That's up from 8 cents a year ago. Profit was up 50% as well. CEO Daryl Albertoni said people are dressing up their cars. They're looking for more creature comforts because they're spending a lot more time in their cars due to the pandemic, of course. So modest price target increases here, but I do note this one because we've got plenty of upside to those target prices with a buy, overweight, and buy. It's a pretty consistent theme there from the brokers. Bendigo Bank, one of those banks reporting this week. We saw some really solid price target increases as well from the brokers, but generally to where the price is right now, 1.9% rise in cash earnings. It didn't exactly shoot the lights out, but the dividend was 24% lower. Okay, so that's another little bit of a downside point there, but the dividend was better than expected. So analysts were expecting 15 cents a share. We got 23.5 cents a share, down about 24% the previous year, but as I said, better than expected. They reaffirmed their dividend guidance for the full year, so that's positive as well. BHP came out with their half-yearly results, best half-yearly profit in over 9 years. Shareholders were going to get $1 a share. That's up 55% for that dividend, and well ahead of the 84 cents analysts were expecting. The underlying profit, however, of 6.03 billion US, so nearly 8 billion Australian, was actually just a little bit behind market expectations. But overall, look very, very solid. Into the next page, and we keep going here. Breville Group, the CEO Jim Clayton said that the shift to working at home had given them a bumper result, 29% increase in their net profit for the December half, but didn't seem to bother the brokers too much. They were very positive. We can see 4 price target increases here by significant magnitudes, and still plenty left in the share price there with outperform, overweight, buy. 3 out of 4 brokers very positive on that one. Heading down to Charter Hall Group, they upgraded their earnings guidance for FY21. Plenty of deal flow, plenty of capital coming into the business, almost $50 billion of funds under management now. They said that their earnings per share was going to be 55 cents, and that was better than its previous guidance of 53 cents. So brokers, small upgrades in prices, yes, but still plenty seen in the share price, and 2 out of 3, they're pretty positive on that one. Into the next page, we've got Crown Resorts. Now, this is an interesting one because we've got 4 price target upgrades there, but they reported a $121 million loss. Revenue was down 62%. At Crown Melbourne, down more than 90%. But brokers kind of looking past the valley here and looking to the other side where hopefully the growth is coming. We did see those price target increases, a little bit mixed in what's left in it. I'd say Credit Suisse, the most bullish broker there with 17% upside, outperform on that one. The rest of them are a little bit more circumspect. Maybe UBS with the buy is the other positive broker. Domain Group, they also saw revenue fall, but got price target increases, 12% down on the previous year. But their profit was up, so revenue down, profit up. I guess that's a positive. They did note, however, that costs were potentially on the increase. Brokers, again, taking that result in their stride and increasing price targets quite nicely there, with a fair bit seen from Macquarie, Morgan Stanley, UBS, outperform, overweight, 2 out of 4, I guess, with the ratings. Domino's, a bumper December half. Their profit cracked $100 million for the first time. It's a 41% increase in that profit. Japan was a standout performer, but Europe was also very strong. They increased their dividend to 88 cents a share, up from 66 cents previously. So that's a big jump as well. And hence we saw the big jumps in price targets, but not a lot left in it, according to a bunch of those brokers. And accumulate, outperform, 2 out of 4, I guess, seeing the positivity in the rating. Having a look into the next page, we keep going here. JBH, they had a pretty good profit result as well. The sales were up 24% and net profit was up a whopping 86.2%. Their dividend was up by 82% to $1.80 a share, so that is tremendous. JB Hi-Fi said that the outlook was a little uncertain, not because customers weren't spending, but because of severe stock shortages out of China due to the pandemic and their inability to get goods here on container ships. There's a shortage in container ships at the moment. So brokers, I guess, responded to the strength of the result, the strength of the consumer outlook with some price target upgrades here, and still quite a bit seen in the price, although we don't have some great ratings to back that up. Maybe because of that caution going forward, maybe because the stock has had a pretty good run. In terms of National Australia Bank, they had their quarterly update, so that was pretty flat on their net profit for the quarter at $1.7 billion, but given it's flat, it's probably better than most expected, to be fair, when you take into account the COVID pandemic and circumstances relating to mortgages and arrears, provisions, etc. Credit Suisse said it was a very clean and solid first quarter trading update. And where's Credit Suisse? 3.8% increase in the price. Still sort of 5 to 10% seen in the upside there. Macquarie perhaps the most bullish there with a 10.4% increase. But we're seeing an outperform, accumulate, and a buy there. So 3 out of 5 ratings positive. On NAB, heading into the next page, I think just to keep things moving along, Rio Tinto, they came out with their biggest dividend in history as part of their half-yearly results presentation. The dividend for the year was $5.57 US. We had a US $12.4 billion profit for the year to December 31, and comparing that to expectations. So 557 on dividends, expectations of 480, so blew that out of the water. The profit came in at 12.4 billion US, and we were expecting 11.7, so again blew that out of the water. So very positive for Rio. Brokers, small price target increases, but a fair bit seen in it there, at least from JP Morgan. They've got a buy and an outperform from Macquarie, 2 out of 3 positive. SGM, which is the metals and scrap recycler there, 480% increase in their EBIT. 5 brokers with price target increases. Modest amount seen in that. Most bullish, I'd say, is Macquarie with an outperform, and then UBS with a buy. Heading into the next page, deep breath. We're still going Super Retail Group. Where are they? Down here. Plenty seen here in terms of upside. Outperform, overweight, and bias at 3 out of 3 positives. They had 23% sales growth. Net profit was up 140%. And of course, they owned Rebel, Supercheap Auto, and a bunch of other consumer brands. They said that they were very clever because they did a big capital raising in the middle of 2020 and used that money to buy a whole heap of stocks. So they're not suffering from the same problems, for example, that JB Hi-Fi was suffering for. But at some stage, I guess that stock's going to run out, and that is a problem for retailers going forward. Down to 7 group holdings. So for price target increases, pretty decent increases, but more importantly here is how much we've still got in terms of upside. So 15 to 20%, outperform, and buy, and that was on the back of their half-yearly results. We saw earnings before interest and tax up 14% as new commission was commissioned for big projects by BHP and Rio. So these guys do heavy equipment. Westpac is the brand over here in WA, and they supply a lot of those big mining companies amongst a bunch of other things. It's a real conglomerate, 7 group holdings now. Heading into what used to be part of the group but then got spun off by Kerry Stokes is 7 West Media. So these obviously owned Channel 7, the channel, the TV network, I should say. And, as retail businesses get more confident, they spend more money on advertising because we're spending our stimulus checks and our increased savings, aren't we? So massive price target increases here for 7 West Media, quite extraordinary. Still quite a bit seen in the price target here. Outperform, accumulate, outperform, and buy. I'd say brokers are pretty positive to this one, aren't they? So they said half-year earnings were up 24%, but revenues down 10%. Of course, still feeling some of the impacts from that pandemic. Into Treasury Wine Estates, they're saying that they're trying to find other markets for the wine that China's not taking at this point in time. They're even trying to grow their grapes in China. So there's some upside, I think, coming into the stock. The brokers are starting to see that now. The chart's looking very interesting as well, starting to turn around. So we've got 3 price target increases here. But interestingly, they're all above where the stock is. Just the JP Morgan there with the accumulate at the moment. But I think, I'm not saying it's all guns blazing just yet, but I think it's something you want to just keep an eye on for now. So they're catching up to where the price is, a little bit tentative, and we'll see if they start to go ahead. Into Westpac down the bottom there. They had their quarterly update out as well, and cash earnings were almost $2 billion. That was up 54% on the previous corresponding period. Very impressive. Their outlook was very positive as well. They saw significant progress on their loan book, mortgage growth, etc., etc. Peter King, CEO, said things are tending to snap back pretty quickly, so that's a good sign from the CEO, and a good sign when the brokers are all upgrading the price target, and a little bit left in that one, but we've got outperform, overweight, and buy. I'd say the brokers are pretty confident. And we'll finish off the price target increases with Wesfarmers. They saw a 23% increase in their profit. They also increased their dividends by 17%. Brokers, small increases here, and the stock has a pretty good run, and that means that most of those price targets are showing that the stock is fully valued. Not a lot of positivity on the rating as well. That's interesting. So, good result, price target increases, but not a lot of upside seen left in this one. The stock has had a pretty good run. And with those ratings of sell, why am I ticking that one? Sell, neutral, lighten, neutral. Yeah, it's looking a bit depressing for old Wesfarmers, isn't it, in terms of the brokers? But look, quality stock, quality result. If I had it, I would certainly hold on to it. Having a look into the price target decreases, so not so lucky this week. Altium, the technology company there, they came out with not a great result. Look, their revenue fell for the first time in 8 years thanks to what they described as extreme conditions due to the pandemic in US and Europe, where they do a lot of their business. Revenues were down 4%, which all things considered is probably not a bad result. EBITDA was down 15% though. They updated their full year guidance to the lower end of the previous range, and that was below analyst estimates. So we did see those price targets come down there from the brokers, but encouragingly still plenty seen in terms of upside. We've got an overweight and a buy there, so it's something to take out of that for shareholders. Looking down the list, Beach Petroleum, there's not a lot good in this report as well. So they said that costs were trending higher, revenues were down 22%, net profits were down 54%. They downgraded their full year production and guidance by 5%. So I can't, earnings down. Originally they were expecting sort of 900 million to 1 billion. We've gone from 900 to 950. Brokers didn't like it. They were all downgrading their price targets. But still plenty of upside seen in it. That's something. Outperform buy, outperform neutral. I guess they're a bit more optimistic about the stock than I am anyway. The next page shows Coles Group. They had an 8% increase in their revenue, 14% odd increase in their net profit after tax. The headline number looked fantastic, but then the CEO came out and said, I'll quote him here, he said, "The pig in the python is starting to diminish." And by that he means that Coles and other supermarket groups ate a giant, had a big feed, didn't they, during COVID, and that the benefits of that are starting to diminish. And then when you look at future halves and comparing them back to the bumper couple of halves they've just had, those comparisons are going to be much harder. Brokers generally said that competition's increasing, costs are increasing as well, so they weren't very happy with that result. The share price did actually fall quite sharply also, as we'll see when we get to the stocks of interest. So we're looking at 0 to 10% price target decreases. Still some upside seen in it though, but with all neutrals, hardly anything to get excited about. CSL, major stock in the index in terms of market capitalisation. So its move, I think, on Friday really hurt the broader index. We're seeing some big price target increases here. I would suggest that's an extra 9, and JP Morgan didn't reduce their price target by 90%, but more like a few percent. But the other ones look pretty correct here. Not a lot of enthusiasm from 3 out of 4 of those brokers, just UBS carrying the torch there with 20% upside and the buy, but I'd say they are an outlier. We'll talk maybe a bit more about the CSL result when we get to the stocks of interest. Heading into the next page, we've got Mirvac Group. Their profits were down 22%. They did restate their guidance, or I guess they initiated their guidance after pulling the guidance earlier in the year, so that's a bit of a positive. JP Morgan said that it was a good result, but the guidance was a bit soft. Nonetheless, we saw price target decreases, but I guess the strength of the result overall probably just helped these ratings stay and outperform and buy there, with quite a bit of upside still seen in the share price, to be fair. So I guess one of those COVID impacted stocks where we've got that short-term dip and the brokers are still seeing long-term growth out there. Heading into the next page, I think we might finish this off with, I'll let you press pause on that if you like, but I think we might finish this off with Woodside just to keep things moving along. They said that underlying earnings slumped more than 50% as lower oil prices took their toll. They declared a dividend of 12 cents a share. That took the full year payout to 38 cents, and that was down 58% from the previous year. So, disappointing result from Woodside, but you would expect that with the big recovery in energy prices, that is probably behind them, and I think the brokers were feeling that way as well. Yes, we did see price target decreases, but very, very small ones, and we've still got some upside in here in terms of those targets. And we are with an outperform. I was hoping to find another one there, but it didn't really make my argument, did it? 2 out of 5. It's not terrible, but it's not great either. Okay, we talked about Coles already, but let's see what the brokers had to say about it. So obviously Citigroup downgraded from buy to neutral. Credit Suisse from outperform to neutral. Those price targets came down by around about 10% at those brokers. We obviously noted the management's downbeat assessment of the supermarket sector. I discussed that. That's Macquarie Bank. They also lowered their price target, as did UBS, but other things as well. So negative earnings drivers going forward, higher costs, higher competition. Issues are likely to persist in H2. So if you dug into the result, it really wasn't that fantastic. Except for UBS, they're always the standout, aren't they? UBS are optimistic that the sector will emerge, the broader sector will emerge from the pandemic in better shape, which it probably will. Having a look at some of the other broker moves there, and these will update. So obviously this data provider takes a few days to collate these and then put them in the system. So, it'll change a little, but broadly I would think still positive on Coles. Reflected, I think, in the chart, it's not a train wreck of a chart, although I am concerned about the breaking of this long-term uptrend here. It does not bode well. If it can't get back up there pretty quickly, I'm very concerned about it. In terms of the mean estimates, look, they'll update a little bit to the downside probably. Looking at the numbers here, probably the big numbers here for me are the PE and the PE growth ratio. You wouldn't exactly say the stock was cheap. Anything over 20 is starting to get expensive. The growth is not fantastic because we typically want to see something here sort of less than 1 on our PEG, which is our PE divided by our growth rate. And at 2.29, it's not great. It's enough to bring the PE down in FY22, but not enough to get me excited. And whilst, historically we have seen some good returns on equity and invested capital, which is great for the business, I just can't see it being a compelling. I can't see the stock as compelling value here. So it's a no for me on here. It's a no for me on here, too cautious, and I think that's a question mark as well. So look, it's an avoid as far as I'm concerned. Having a look at CSL, as we said, an important stock for the market overall because of its market capitalisation. They had, again, another really fantastic headline result. It looked on the face of it like a 45% increase in net profits, at 17% increase in revenue. But when you dug into that result, most of that upside came from their flu vaccines in Europe and the US. Of course, we're in a northern hemisphere winter, so everybody's out there in advance of that COVID vaccine. They don't want to get sick, so they're getting these flu shots. We're heading into spring and summer. That's going to back out. In fact, CSL said that division will make a loss in the second half. Seasonally, it happens, so it's not a surprise or shock to the market. It's just what happens. Underlying that, their bread and butter business, and it's kind of weird to say this, but their bread and butter business is blood plasma. And obviously they need to collect the plasma. It's been hard to do that with COVID. Lower collections means lower production of their products and therefore lower sales. Now that's going to back out. It's going to change. We're going to get back to normal at some stage, but it won't be this year, and it might be well into next year and maybe into FY23 before we start to see the growth that this fantastic business had pre-COVID. So that's the worry for me. Normally with a P of 40 for CSL, you're not too concerned by it because the growth has been there. But you can see from that PEG, it's twice as bad as Coles. The growth isn't in that business anymore, and it's certainly not enough to make a dent in that PE going forward. So it's a no for me on that basis. You don't have the dividend yield in the meantime to keep you going. So despite, yes, these are fantastic, and historically I can't make a case. The chart doesn't look fantastic because we are, that long-term uptrend is under real pressure here, and we're in a short-term downtrend as well. So with a no there and a no there, there's not a lot to keep me going in the brokers as well. Downgrade here, buy to neutral from Citigroup, outperform to neutral from Credit Suisse, buy to neutral from Goldman Sachs. We did see those price target decreases earlier on, all but Macquarie with price target decreases. So Macquarie only going up by $3 there anyway. And you can press pause and read that up because they're going to discuss all the same things I've talked about here. So that's still a question mark. So it's a no for me on CSL. A yes coming from me on Westpac, because straight away we can see the charts heading in a different direction. We've got this wonderful short-term uptrend. The long-term trend is about to switch to the upside, so that's going to provide some tailwinds as well. The brokers, we don't have to say we're waiting for the data provider update here because there's nothing adverse to what we're seeing here. I don't know who that is, certainly not on screen because we've got an outperform, yes, a hold, but an outperform, an overweight, and a buy here from the brokers surveyed this week. Price target increases across the board, some of them by substantial amounts, and all the words seem to be good. So, growth returning to the mortgage book, cash earnings ahead of expectations. They've got progress on write-downs, provisions, their margins are improving, and that's echoed through all of these. So, pretty positive there. In terms of the valuation, look, the PE is high for the banks at the moment, yes. I mean, it has had a good run, but the growth is coming through to bring that down. And therefore I'm happy to give it a go. And with the dividend yield, at least you're getting compensated with a really good dividend yield in the meantime, and it should go back to pre-COVID is my expectation. So we've got a nice trend here. I don't think you need to rush out and buy it, although if you did want to buy it here, I'm happy to. But I think you can wait for pullbacks, and you might find this area around 23 to 22.50 as the point where you can top up your holdings on Westpac. So happy with that one. Okay, that's it for me today. Plenty of market news updates coming because of earnings season in this section of our website. You can follow me or the Think Markets handles on Twitter. Also go to the website and register for any of our Think Learning webinars. Ask the Experts coming up on Wednesday, March 3. That's where you get to ask me about stocks in your portfolio, and I'll give you a quick fundamental and technical, and then we will have 3 stocks with dividends and growth and how to create an investing plan coming up on the 10th and 24th respectively. Before I leave you, of course, the disclaimer which says that everything we've talked about today is general in nature. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So before acting upon any of this advice, read this disclaimer carefully or give us a call. Thanks for joining me this morning. Plenty to get through. Hopefully you got lots out of it. All the best for your trading. Until we catch up again. Bye-bye for now.